Hello.
Hello. Okay, good afternoon, everyone. I see some people are still joining us, but we're going to go ahead and get started. My name is Ashley Fobb, and welcome to our Create You Professional Development webinar series, sponsored by IT Inspired. I am the Director of Communications and Development for the Arts Council of Greater Baton Rouge. To learn more about the Arts Council, visit artspr.org. Don't forget to come out to Ebb and Flow Festival next weekend, April 6th and 7th. For more details on programming, performances, and schedule, make sure you download our Flow BR app or visit ebbandflowbr.org. Now let's begin on our webinar. We are so honored to have two of the best in the business, Ralph Stevens and Bill Potter from Postlethwaite Netterville. We are so excited to have you and presenting financial and tax considerations for artists. Once the presentation has ended, we will be taking questions. So if you look at the bottom of your screen under chat, you can click that button and all the questions come directly to me, the host, and I will facilitate the Q&A portion at the end. So without further ado, take it away, guys.
All right, well, thank you, Ashley. Bill and I will be talking about stuff today, the financial and tax considerations for artists. And again, please send the questions that you've got. We've got what we think are some things that people are interested in, that our clients who are artists are concerned about, but obviously we would love to hear from your particular questions, and to the extent that we know the answers, we'll give them to you. To the extent we don't know them, we will get back with you and let you know. So let's get started. And I am going to try and move the screen down. All right.
Bear with us.
We're accountants. We're not technology guys. There it goes. So do I need that?
Yeah.
There you go. All right. So the first thing we're going to do is we're going to talk about the selection of the form of your business. So you're an artist, you have a business, you're trying to decide what's the best way to go. Should I stay as a sole proprietor? Should I be a partnership? Should I be some sort of corporation? We're going to talk about the different ones, and we'll give you some ideas of some of the pros and cons, and then we'll go through those details later. The first thing, to be a sole proprietor, that's easy. It's the easiest form of business to be out there. You don't have to go and do anything to register. You may have to register for some sales tax and things like that. We'll talk about that. But in terms of setting up the business, you don't have to go to the Secretary of State. You don't have to form a separate entity. You simply report the income and the expenses from that form of business on your personal tax return. Bill, you want to talk about partnerships? And
yeah, that's on your personal tax return with the Schedule C for that sole proprietorship. Partnership or joint venture, or LLC, that is more formal going into that. Right now, we probably see across the board in all the businesses we deal with, the LLC is a preferred entity. And I think the records at the Secretary of State's office say about 12 LLCs are formed for every one corporation these days. An LLC can have one owner or it can have multiple owners. So, if you're going to start out your business where you may be taking in others as owners, then you'd probably want to start as an LLC. If you start as an LLC as the only owner, you can basically, for income tax purposes, ignore that entity and still report just like the sole proprietorship. But it does have flexibility. Say pass-through entity, if two or more persons other than spouses own an LLC, they're treated as a partnership for federal and state income tax purposes. And items of income and expense flow through and are included in the individual tax return. A lot of people use LLCs because of liability issues. There's some protection. I think probably for an artist, it's not that critical, but that's one of the additional benefits that you get from that.
So, and in terms of the liability, what Bill's talking about is, again, this isn't a tax issue, but it's more, my guess is, for example, if you're a performing artist, if you're a singer or somebody like that, probably not a lot of liability. If you are a flamethrower or twirl flaming batons, or you maybe have a shop that you bring people into that potentially has things, or if you're teaching lessons and people are working with equipment, for example, you may want to consider whether you want an LLC for liability purposes. The other thing to think about when you're forming your LLC, again, the basic documents to form an LLC are very easy. And so if you're a single person, a single member, and you want to form an LLC, it can be a very basic document. But once you form it, or once you form and you go get another partner, another person to become an owner, then you want to look at the LLC agreement and the operating agreement to make sure it spells out how you get people in, how you get people out, how you share profits, things like that. So that very basic agreement that you had when you started may not be the same agreement you have if you bring in another partner.
It can be money well spent to get a competent attorney to help you set this up. The detailed documents of organization and having the items Ralph was talking about, how do you get out? What happens if someone dies? What happens if there's a divorce? Things like that are critical to have those in those initial documents.
And then the last form of doing business is being a corporation. And there's two kinds of corporations, S corporations or C corporations. S and C refer to subchapter S and subchapter C of the Internal Revenue Code. Again, that's classically, 40, 50 years ago, you were either a sole proprietor or a partnership or a corporation. We didn't have LLCs. Now, not nearly as many people are forming corporations, although with the Tax Act that was passed last year, if you're one of those artists that makes a bunch of money, you may want to consider whether or not you are a corporation, you want to be a C corporation, because C corporations now pay tax at a 21% rate versus the highest individual rate, which is 35% no. So there are some advantages to do it. There's some potential advantages to saving on payroll taxes, which we'll talk about as we go through it. But those are the three basic types of entities. Now, if I get my tech guy, Chris, to tell me how to move. How do I move it down? Oh, there we go. Right with the wrong way. There we go. So in terms of taxation, we're going to talk about several different types of taxation today. And so while it's going to sound sort of complicated in some senses, because there's a lot of different considerations, it's also the reason why somebody says, I'm an artist, I'm a painter. What type of entity should I be, and how am I going to be taxed? Lots and lots of different questions and lots of different things that can go into the decision as to what type of entity and how you're going to be taxed. So the types of tax we're going to talk about are income tax. Everybody right now is busy, hopefully, filing their individual income tax returns. And so if you're a C corporation, you'd have to file your corporate income tax return as well as your individual tax return. We're going to talk about payroll taxes, which are going to be both for you as an employee and as an employer, as well as self-employment tax. The payroll taxes are, for many people, are a fairly significant tax. You can pay up to certain levels. You can pay as much payroll tax or self-employment tax as you do income tax.
Right. If the self-employment tax is 15.3% up to $128,000 of income. So that can be a significant tax, and that's in addition to paying income tax on that money. So that's certainly something we always warn people about, that particularly if you have two spouses, one that's got a W-2 and another one that's self-employed, that self-employed person may start off paying about 40% tax on the first dollar they earn. So certainly beware of that.
So the other kind of taxes we're going to talk about a little bit are sales tax, and then we're going to talk a little bit about the new tax act. Sales tax, again, Louisiana, we have managed, and Bill is much more of an expert in sales tax than I am, but we have managed to take what should be a fairly simple tax and make it a very complicated tax. As you know, you buy when you buy stuff at the store, you pay sales tax on it. There's lots of questions these days about internet sales and sales tax on internet sales and how that's getting taxed. A big thing for you as an artist is you don't pay sales tax on items for resale, but in order to do that, you have to have when you purchase it, you have to have an exemption certificate from the person that you are when you're entering into that transaction.
Right. For instance, if you're an artist that sells your portraits, your paintings, the items for resale that you buy, so your paint, your canvas, your frames, you can get out of paying the sales tax when you purchase those, but then when you turn around and sell your painting, that's an item of tangible personal property, and it can be subject to sales tax, both state and parish tax. We did have a cultural district exemption where items sold by artists within that cultural district, which was basically in downtown Baton Rouge and I think the French Quarter, New Orleans, and several others, based on some of the recent legislation where they were trying to get rid of some of the exemptions, those have been suspended right now. So you would be obligated to collect sales tax and from your purchaser, and then remit that to the state and local entity. Also, if you buy items from out of state, Ralph mentioned internet sales. If you are not charged on those items, and if they're not for resale, then you may have to pay a use tax. That's a mirror tax to a sales tax, so you need to be aware of that.
And in that case, for individuals, you're supposed to report that on your Louisiana income tax return, and many people do, many people don't, but many people do. And but for businesses, the state and the city and different taxing authorities will actually audit you. And one of the things they audit when they're looking for sales tax is they will look to see if you bought items that were not for resale that you didn't pay sales tax on. So I haven't ever seen them audit an individual, but they certainly audit businesses for that, and they could audit individuals.
Yeah. A big issue right now nationwide is what if you sell your items, sculptures, paintings, or whatnot out of state? What is your obligation then to collect sales tax from the purchaser? And the U.S. Supreme Court last year came out with a ruling that said states can collect from out-of-state vendors in that situation. However, it will depend on each state as to what their exact law is, but basically what they're saying is you have to have over 200 transactions in that other state, and typically your sales have to exceed $100,000, but it varies state by state. But if you have an active business and you're selling out of state, you need to be sure you're aware of that, because you want to collect sales tax from your purchaser, and you don't want to be stuck with it yourself in that situation.
So, in that regard, and we're going to go back and forth with a number of these taxes. I wanted to kind of spell them all out, and then we'll talk about things that are important. But one of the things that is not subject to sales tax is a casual sale. So let's say you're the artist, and you're not really in it for business, but every now and then you sell a sculpture or a painting, and you can make the argument that you were that was a casual sale. So if, for example, I'm not if I have a garage sale in my house, it has nothing to do with art, but if I have a garage sale, even though I'm selling tangible personal property, do I have to collect sales tax? No. Why? Because it's a casual or an occasional sale. Now, as you move into being more in business, and you say, well, I want to write off some of my expenses with that, then you're going to have more difficulty arguing that those sales are in fact casual sales. So we're going to see where some of this stuff overlaps. For example, I'm going to go backwards if I don't mess up the technology on it. Oh, there we go, the payroll tax. And we're going to talk about employees. Again, there's a lot of misconception, and again, a lot of people probably have some people that work for them on a very part-time basis. And people say, oh, they don't work for me very much, so therefore I'm going to treat them as casual labor or independent contractors. That's not the test for the IRS. The test for the IRS is that person under your direction and control? And if they are under your direction and control, then they're your employee, even if they're only there for a week, or even if they're only there for to help you set up for a few shows, for example. If they are under your direction and control, technically they're your employee. And I have people all the time ask me, oh, but they only work 5 hours a week for me, or they only came in and did 2 weekends for me. I don't have to set them up as an employee. They're not really my employee. Technically, they are.
Right, and that's a big misconception that we've seen over the years with this idea of casual labor, and that's, as Ralph said, that's not the test. Now, the problem that you would face is if you did not properly withhold from them, the IRS could come in and collect 10% of their wages as income tax withholding that you would have to pay, plus you would have to pay your half of the Social Security Medicare tax as well as the employees. And they can go back, and I've seen them do this, go back for 3 years on people. You've seen a lot of things in the news about people not paying their domestic help. Well, the same thing can apply in this situation if you are trying to say, well, they're casual and I don't have to worry about the employment tax situation.
The real test on that is again, are they under your direction and control? And it's kind of looking at, do they have a real business? Do they have, are they available to other customers? Do they advertise? That's the kind of thing that the IRS looks at. So, for example, if you have a CPA that is a sole practice CPA and you pay them to do your tax return and things like that, are they your employee? No. Why? Because they have a separate business that they are doing. Is your lawyer your employee? No, because they have a separate business. But is that person that comes in and helps clean up your place in the afternoon your employee? Unless they're a service, probably so. So let's talk about. So you've got all these different things. You got sales tax, income tax, payroll tax. So you're an artist. What do you want to do? You know, what kind of business do you want to have? What do you want to do? Do you want to be a corporation, self-employed, whatever?
Yeah, Ralph, and probably an important thing to point out is that, let's say we're talking about one person and they're thinking about maybe doing a single member LLC or a corporation. What happens if they're a corporation, whether it's a C Corp or an S Corp? They may be wearing two hats. They're the owner and they can be an employee of the corporation. And so that means that that corporation is going to have to start reporting and filing payroll tax returns, whereas you can avoid that if you're a sole proprietor and a single member LLC. You're not avoiding the tax, but the tax is much easier to report and pay. It's done through your individual income tax return in that situation, and not separate payroll tax returns.
Right, and so you know, if you're one of those artists that's not the starving artist, but the artist that makes a lot of money, and let's say particularly if you make a lot of money because you have people working for you, so you have people who are actually producing your artwork and reproducing it. One of the things that you may want to consider is being an S corporation, because like Bill talked about, you can wear two hats. And so you could wear one hat as being the person who works for that S corporation, and you would get paid some sort of salary for working there, for the sweat of your brow. But you could also take home some money as the owner of the business, as the person who is the entrepreneur who has hired these people to work for you. And the advantage of doing that is that as the owner of the business, when you're wearing that hat, you pay income tax on what comes out of your S corporation, but you do not pay self-employment tax on that, because you are earning that as the owner of a corporation, not as somebody who works for it. Now, what happens if, and you notice I mentioned, if you have a bunch of employees. So let's say I'm just a successful artist and I make $100,000 a year, but it's all because of what I produce. Can I become an S corporation, pay myself a $10,000 salary, and take $90,000 of distributions? So if you do that, then the IRS can look at you and say, you're not earning this money from doing anything other than your labor. And so you're really not earning this money as the owner of the business wearing that hat. And the IRS could look at you at that point and say, we're going to hit you for the payroll taxes because you can't justify taking any money out as an owner.
Right. That's there. For years and years, there have been a number of cases where incorporated professionals try to skirt the payroll tax by taking it out as profits and not as wages in that situation. And there are a lot of cases. And what the IRS does is they say you have not paid yourself a reasonable compensation, and you're avoiding the payroll tax. Again, they can come back on you for 3 years or more in those situations. So get good advice if you're going to use an S corporation as to what you ought to set your salary at.
Yeah. So, and again, both with the whether you're an S corporation or you have employees, as Bill already mentioned, one of the big considerations of doing that, the reporting and the paying of the payroll taxes, there's different times based on the level of the payroll tax that's due, but that's much more burdensome from an administrative point of view. Now, there are some good services out there that do it, Paychecks and the Net Checks and ADP, and if I'm leaving somebody out, I don't mean to. I'm not recommending any one of the other. But one thing I'll say there, the IRS often, I know a lot of people are really scared of the IRS, but if you mess up on your estimated tax payments, or you mess up on, you don't file something on time, usually the penalties aren't severe. The payroll tax penalties are very severe very quickly. And so if you don't do payroll taxes and don't do them right, very quickly you'll get up to where the penalties can be 20 and 25% of the tax due. So if you are in a situation where you wind up with employees, one of the things that you want to make sure that either you can do it, you have a bookkeeper or accountant that'll do it, or you get one of these services that'll do it. The services are actually not real expensive for what they do for you, but it's very important that you get your payroll taxes paid on time.
Another point on the self-employment tax, if you're operating as a single member LLC or a sole proprietor, that self-employment tax is paid in your individual income tax return, and you have an obligation to pay as you go with making quarterly estimates. And we see a lot of people, they may get in that situation, particularly their first year, they're making money. And that example I gave earlier, suppose the spouse is also working, you're filing a joint return, and all of a sudden you find out that you're paying that 40% of income tax and self-employment tax on that. And a lot of people don't pay as you go. They don't make those quarterly estimates. And they find out when they file their return on April 15th of the next year, they owe this money. So
as well as a penalty.
Right. You can have an underpayment penalty. So I counseled somebody just a couple of weeks ago that had just become a sole proprietor in a business. And I said, put the money aside now or pay the quarterly amounts. Don't think that that every $100 you earn is pure profit, because you're going to owe that maybe 40% or less than that, maybe. But don't get behind in paying the taxes.
Went the wrong way again. All right, so look, quickly, go ahead.
I have another comment on sales tax, that a lot of artists go to festivals and fairs around the state and around the South and whatnot. And if you're physically in another jurisdiction, another parish, another state or whatever, you can owe sales tax on your items that you sell at those festivals. So be aware of that.
Both to the state and to that local jurisdiction.
Correct, correct. So be aware of that. I mean, some places have exemptions for those types of activities, but a lot of them don't. So actually what Louisiana will do, sometimes they'll send out auditors at these festivals and see if people are remitting their taxes in those situations.
Right. So the new Tax Act, we like to call it the Full Employment Tax Act for CPAs because it's kept us quite busy this year. And a couple of things to keep in mind with that is, or to be aware of, they increased what's called bonus depreciation, which basically means that for almost any equipment that you buy, you'll be able to write it off in the first year. I say basically because there's some limitations on cars and things like that. But so the good news is that you'll be able to if you go out and you buy, like a kiln, for example, or an expensive piece of equipment or a musical instrument, you can write it off in the first year. Now, what you do need to be careful of is if you finance that piece of equipment, some of our clients get in a situation where they're all happy because they take this big bonus depreciation the first year, and then the next year they're still paying for that piece of equipment, and so their money, their cash is going away, but they don't have any tax deductions to go with it because they took it all in that first year. So just be careful with that. The elimination of the employee business expense. I know I have a number of clients who are maybe an art teacher at a school or a professor at LSU or Southern, and if it's an art teacher, they may have expenses related to the supplies they buy. They were able to deduct those as employee business expenses. That deduction is gone.
Right. But it's important to keep in mind we're talking about employee business expenses. If you are a sole proprietor, or if you are operating in one of the entities we talked about, those business expenses are still deductible in that situation. So again, if you formed a corporation and you're an employee in there, you want to make sure that those expenses are being deducted at the corporate level and not at the individual level. They are completely disallowed, effective in 2018.
And so for a lot of people, again, I have several clients who are like professors and they have their business on the side. So what you need to be able to do is say, yes, I can justify these expenses as part of my business as an artist, as opposed to my teaching as a professor. And so, because the expenses for teaching as a professor are not deductible, the deductions for your business are. Again, we mentioned earlier the lower corporate tax rate. If you make a lot of money as an artist, you may consider whether or not you want to have use the lower corporate tax rate because it's only 21%. And if you're thinking about that, it's probably something you want to talk to a CPA about.
You have to plan not just for the specific year, but going forward as to what your expectations are for the level of business and also what you want to do with the earnings that are left in that corporation.
And Section 199A, we're not going to read any code sections to you, but basically what that is it's a freebie. It's a 20% deduction for your net income that comes out of one of these businesses. And so there's lots and lots of rules and regulation and uncertainty with it, but there's but generally if you're making money as an artist, you need to look at whether or not you qualify for Section 199A, which gives you a 20% deduction on your bottom line, and that's just a free deduction. So that's a good thing that came out of the new Tax Act. We're going to talk quickly about the acquisition of equipment and just some things that you want to think about. If you get in a situation, do you lease the equipment or purchase the equipment? Again, it used to be, from a tax point of view, you got a better deal if you leased it. Now with with the bonus depreciation, you can write it off completely if you purchase it. So this really becomes an economic decision.
Right, and you also think, if you're having to borrow the money to do the purchase, what is the interest rate you're paying on the borrowing versus what is the interest rate that's factored into the lease?
Yeah.
And typically a lease probably has a little bit higher rate, but that's just something you want to look at.
Right. And again, if you're acquiring equipment, do you acquire it individually or do you acquire it in the entity? Just something to think about if you have an LLC or a partnership or one of the corporations.
Yeah, I think generally we would recommend that if you're using an entity, have the equipment in the entity. But there can be other reasons. If you're about to get out of the business or you want to sell the business and be able to rent the equipment to the new purchaser of your business, things like that can come into it.
Right. And you may have a different consideration if you have a building, for example. If a lot of times people will want to own the building, maybe in one entity, and have the business in another entity because they may want to keep the real estate for longer than they wind up disposing of the business at some point. Automobiles, I imagine at the end we'll get some questions on automobiles. Again, there are lots of ways to use your automobile if you use it in business to take advantage of it. Generally, what you're looking at is you can do one of two things. You can take whatever business percentage of the actual cost of the vehicle, so your gas, tires, oil, insurance, whatever business percentage you use of the car, you can use that, as well as depreciation of the car, or you can take mileage, and mileage is, I think, 58 cents a mile right now. Yeah, I think it's 58 cents. It changes every year, or really every 6 months. Yeah. And so, and what you want to look at there, you're basically, if you're an employee going to the office and going home, you don't get any of that, but you're looking at the miles you use in the business. And so, if you go to the fairs and the exhibits, the mileage driving there would count as mileage. Driving to visit your CPA and your lawyer and going to the bank, all that counts. Driving your kids to soccer practice does not.
Another thing to keep in mind, automobiles are kind of a mixed use property. There's personal use and business use. If you had a corporation that owned the car, but you used it to commute back and forth, there could be some personal income you would have to pick up for that. And that's something the IRS agents love to look at, is to, are you deducting the full cost of that automobile and its operations in that corporation, yet you're using it some personally and you're not picking up income for the personal use of that company vehicle in that situation.
And the same thing with cars. You want to look at and on the personal use, again, the IRS would like you to do a mileage log, and every time you get in the car, write your odometer, write it down. Do people do that? No. But should you trade, if you're going to use, particularly if it's going to be a lot of mileage, you ought to consider some sort of contemporaneous record, whether it's you use your Outlook calendar, whatever you use to keep track of your appointments or where you're going, but something so that if the IRS comes back and looks at it and you've deducted a bunch of mileage in a year, you're able to go back and say, yeah, I kept a record of where I was going and what I was doing.
Or at least do it for a couple of months out of the year or something.
Yeah,
and we usually recommend to clients, again, if it's an entity-owned automobile, go ahead and make some kind of allocation of personal use. And that can be included in the W-2 and the wages that you get from the corporation.
And last thing on the cars is, before you go put them in an entity, one of the things you want to look at is the insurance cost, because often, even though you're going to drive your car the same place, whether it's in the entity or not in the entity, as soon as you put it in the entity, often the insurance cost goes up, because now it is officially an automobile owned by a business as opposed to an individual. The joint venture, again, the only thing you got to watch out for there is if you're buying property with somebody, when I say property, equipment, at the end of that joint venture, who's going to own it? You want that to be very clear. Depreciation, we already talked about. Section 179 is like the bonus depreciation. It's the rapid write-off of the equipment. Accounting systems, we get a lot of questions about this. Now, this is not what Bill and I are experts in. Do you need fancy software systems? Probably not. QuickBooks and things like that are good software systems. If you get sophisticated as your business grows and you're sending stuff out of state, you become very sophisticated, you have lots of clients or customers all over the place, you probably need a more sophisticated package.
Or if you're accountable to other people, other owners or whatnot, then it becomes important.
Right.
There's also, we're going to talk in a little bit about the hobby loss rules. And that's one thing that comes into play there when the IRS is looking, is this really a business or is this a hobby? They want to see how good your accounting system is. Are you really treating it like a business and keeping up with things? Now that, like Ralph said, it doesn't have to be real sophisticated. You could have almost checkbook accounting, but you got to have something that shows that you're segregating personal costs from business costs and keeping up with it on a timely basis.
Right. And when we will get to the hobby loss. We probably should have shown that in earlier, but to that end, whether in the accounting system, if you're really in business as an artist, you want to have a separate checking account. You probably want to have a separate debit card or credit card. You want to have a separate software system to keep track of it, even if the software system is Excel, whatever. But something, what you want is something that is sophisticated enough to keep track of it, but not so sophisticated that you won't use it. So it needs to be something that you will do, but not something that makes it too hard.
Yeah, I see a lot of times when people have an activity and it kind of morphs into a business, they're still running it out of their personal checking account. As Ralph said earlier, it's really important to have a separate checking account for your business activity.
And same thing as your business grows, you may want to look at, do you go get, they're hard to find, good bookkeepers are hard to find, but do you get an outside bookkeeper, a contract kind of bookkeeper to come in and do that? Because to our third point on this slide, knowing where your costs are important. And I'm not surprised anymore, but all the time people come in and they don't really know if they're making money or losing money because they don't keep good track of it. So it's very important if you're doing this to know whether or not you are really making money in what you're doing.
Yeah, we had a case, we were called in. It wasn't a regular client of ours several years ago, but a guy had several different businesses, and he kept each one of them, or he kept them all through one checking account, and he was not allocating the cost to the particular activity. And the IRS came in and made him go back for 3 years and redo everything. And he had to get, he had an accountant, but then they got us involved, and that became a very, very expensive thing for him to have to engage in. But he faced having them disallowed. It's just not being allocated to the proper activities.
Right. Yeah. All right. So in terms of the accounting systems, again, we'll kind of, because I do want to leave plenty of time for questions here. So we'll go through the, again, as you're getting into business, you want to look at, not only do you want an accounting system that keeps track of where you've been, but you want to budget, and you want to budget your regular recurring costs as well as a capital budget. Are you going to need new equipment if you're musician? Are you going to need to buy, more and more sophisticated, more and more equipment if you're a band, for example? That needs to be a part of it. You need to budget that to make your business work. How are you going to fund it? Are you going to fund it yourself? You're going to have a backer? You're going to have the bank finance it?
Yeah, and I'll make another pitch too. In your cash budget, if you're reporting the income from the business in your personal return, make sure you're paying your estimated taxes, and don't wait till you file your return at April 15th and see that you have a huge tax bill at that time. It's hard to catch up paying back taxes and trying to pay your current year taxes. So pay as you go.
So, and whatever accounting system you use, if you do wind up with some folks that need 1099s, if you do wind up with some casual labor or some people who are professionals that you pay, what you do want to have your accounting system that will keep track of, hey, do I have to give this person a 1099? And if you do, have you gotten their information on their social security number, address, and things like that? So for example, if you hire that bookkeeper we talked about, and you're paying them $200 a month, well, the first $200 you wouldn't have to report on 1099 because 1099 only has to get reported over $600. But and you say, well, I'll just use them one time and they'll get me caught up. Well, then later in the year they do some more stuff for you, and for the year it becomes more than $600. You're supposed to give them a 1099, and so you would need that information. So you do want an accounting system, whatever your system is, that will keep track of all the people that you have paid that you may have to give a 1099 to.
And again, the penalties that you face for not complying 1099s can be very, very costly. If you're getting services from individuals, not services from corporations, you probably have a reporting responsibility here. And if you're intentionally not filing those 1099s, the IRS can assess a penalty as much as 10% of the unreported amounts on those. So it can be very expensive.
So I keep going the wrong way. Sorry about that. Travel and entertainment. One thing, entertainment is now out. So if you're deducting things, entertainment under the new tax act is out. So if you were paying for tickets to a play, or taking tickets to a ball game, or taking somebody to play golf or something like that, that's no longer deductible. Meals are still deductible, and only 50% of most meals. There are some meals that could qualify as 100%. Big need for documentation here, though. You need to, again, if the IRS comes in and audits you, you're going to want to be able to say, this is what the meal was for, this is who met, this is why it's a deductible meal.
Right, and it's supposed to be contemporaneous documentation. You're supposed to be able to document who, when, where, why, and how much. And one of the easiest ways to do that is you use that business credit card, and when you get your monthly statement, you make sure you have the right documentation on there for those types of things. This is probably the number one item that an IRS auditor loves to look at.
Yeah. And this, the sophistication of that Section 199A, that's going to be hard for a lot of agents to they're going to have to learn all that. They understand entertainment, so or meals and entertainment. And
there's some very detailed rules. Ralph was saying, like we're used to, if you took someone to a ball game or whatnot, you could take that as entertainment. So that's out. But if you're an artist and you attend, if you're a performing artist and you attend a play, there may be a business element of that, but you've really got to be, again, document that pretty well and really know what the rules are on that.
All right, so for personnel, we've talked about this a bunch. Again, I'm going to kind of go through some of these quickly so we can get to questions. We've talked about the independent contractor versus employees, fringe benefits and retirement. The main thing I'll say there, if you do have employees, or even if you're self-employed, there are some, and you're making some money, there's some opportunities for whether it's a 401k plan or a SEP, which is a simplified employee pension, things like that. So look at those. Same with healthcare. The big thing on all those benefits, if you have employees, generally you can't do anything for yourself that you're not doing for your employees. So that's the big thing you got to watch out for there. Again, use of flex time, part time. You don't always have to cover the flex time, part time people. Same with employee leasing. If you sometimes that's an easier way to get employees. Just go through a leasing company, let them take on all those headaches.
Very complicated area, a lot of details to it. You need professional advice.
Right. In this area. Cool. Let's keep going wrong. Retirement plans, same thing. We just talked about home office deduction. We get asked about this a lot. Again, to take a home office deduction, you have to have income. You're not going to be able to create a loss with a home office deduction. And the home office, probably the big thing is, and it may be for many artists that it'll qualify, it has to be a separate dedicated space. It can't be that corner of the den that you sit and write in, or it can't be a corner of something. It has to be a separate place. Now, if you have a studio and it's separate, then you can deduct the proportionate share of the expenses of the house for the square footage. So if it's 1,000 square foot house and that the studio is 100 square feet, you can deduct 10% of the utilities and the maintenance and all that of the whole house, as well as the particular expenses for that room.
Yeah. And as Ralph said, dedicated to the business, and that means you cannot have any other kind of activity in there. There was a case involving a piano teacher that had a little studio where she taught her students, and she also had a room outside of that where the next ones in line would sit and wait. IRS came in and said, okay, the studio is fine, but you have a dining table in this other room, and I know y'all use that for meals and whatnot. So that portion did not meet the exclusive use test in that situation. Also, home and office deduction has a separate form that you include in your individual return, and this is something else that the IRS will scrutinize.
Right.
So you got to make sure you have your ducks in a row.
And one of the things I tell clients all the time on this one is you really want to look at how much benefit you're getting from it, because if you're not getting much benefit from it, it's one of the things that the IRS likes to look at.
Red flag.
Okay, we only got two quick things. In terms of all this stuff, a couple of things you want to make sure of is get with your insurance agent. And obviously, you know about health insurance, although there are some deductions for health insurance if you're self-employed or in one of these businesses. Disability insurance is a big deal because obviously if you lose your ability to do your business, you're going to want some protection there. Property and casualty kind of speaks for itself. My guess is, unless you're traveling around a lot, most artists probably don't have a lot of liability needs. All right, the last thing we want to talk about, and then we'll take your questions, are the hobby losses. So there's a presumption that you have a profit motive if you have net income for 3 out of 5 years. This, again, is something that not only the feds are looking at it, I now have had twice in the last year, the state has actually looked at this and come in and said that they didn't think that artists were in the business of, that this was a hobby, not a business, because they did not have income. Now, in some cases, you can rebut the presumption by saying, well, we are trying to make money, we're just not making it, and it's not a hobby, but we're really out there trying to make money. In some cases, in the case of an artist, a painting artist, we were able to show that they were building their inventory, and that while they hadn't had a lot of sales in the current year, they did have inventory, and it was for sale, and it was real. But this is, again, something that the IRS likes to and understands and will come after you for if you show loss.
And they have computer models that'll look and see if an individual return where somebody may have a job, regular job, where they're getting a W-2, but then they have this business hobby loss as a sole proprietor on Schedule C, and it shows a loss. And so if they see wages and a loss on Schedule C, a lot of times these will pop out for examination.
So I think that is, I know we kind of ran through the end, but I wanted to leave some time for questions. Now, I'm not sure how we're going to get the questions, but I think they're going to come through on
yes, I have the question. Okay. This is Ashley. Wow, what an amazing presentation. We thank you so much. So let's get to questions. Okay, where is the line for artists between being seen as a casual seller versus a business in the eyes of the IRS?
Well, there's two.
From a sales tax standpoint, is that if that's what they're looking at,
right?
There's not a bright line test on that, and they're going to look at whatever your past activity was, and if they see it on a recurring basis, then they're going to say you may owe, you should have collected sales tax on those, and it wasn't a casual sale. Now, from the hobby loss type thing, they have both objective criteria there, as Ralph was pointing out, about the 3 out of 5 years, and then there's a series of questions that are in the regulations that they look at, where they'll ask if you're operating as a business in that situation.
But let's say you're an artist and you do every now and then sell a painting, but you're really not trying to write it off as a business. You are allowed to offset your costs to the extent that you have income. So if I do a few paintings a year and I sell them for $500 a piece, and so I've got $1,500 of income, I could offset up to $1,500 worth of expenses if I was trying to say I was not in the business. Now, if I have $2,500 of expenses and every year, and I have $1,500 of income, at some point the IRS can look at it and say, no, that's a hobby. You're not making money at it, and you won't make money at it.
The problem though with that offset, sometimes it isn't a direct offset against that income. You may have to pick up the income, and then those could be miscellaneous itemized deductions, which are no longer deductible. So really watch that.
Okay, here's another one. Many of the community artists are on their own, making enough to keep their studio going, but not enough to have employees. If they're making under $15,000 per year on their art, is it worth their time to be an LLC, or should they stay a sole proprietor until they make more?
If they wanted to be an LLC as a single member LLC, that costs you $60 or something from the Secretary of State and is not very hard to do. But the only real advantage of doing that would probably be liability. So if somebody came into their studio and got hurt, they potentially have the fact that they were an LLC may give them a little protection from that. Now, if they have liability insurance, do they need that? Probably not. So if you're that size and you're not getting a partner and you're not worried about liability, no, I don't know that there's a big reason that you need to go be an LLC.
No, I mean, if you like the idea of having a business name separate, that might be a reason. But it's easy enough at that level to stay as a sole proprietor.
Okay. Do you need to set a salary for yourself if you're an LLC?
No.
No, if you're a single member LLC, you cannot, you're not an employee of your own LLC unless your LLC can elect to be taxed as an S corporation, but unless it elects to do that, you do not pay yourself a salary as a sole member of an LLC. Or even if Bill and I were joint members of an LLC, we still wouldn't pay ourselves salaries. We would take what are called guaranteed payments.
Yeah. If it's taxed as sole proprietor or taxed as a partnership, there is no compensation per se paid to the
no salary, no payroll.
Mm-hmm. Okay. Can you talk about LAT 5 forms? What all do we need to report?
I don't know what that is.
I don't
I'm
either.
not sure offhand.
Okay, if you ask that question, if you can just
It
reply.
may be workers' comp.
Okay.
Just off the top of my head, I don't know what that is.
Okay. Do you recommend the separate checking account to be an actual business account, which sometimes has a minimum of $2,500 or more, or can it just be a separate checking account that you log as your business checking and only use it that way?
I think it could be just a separate checking account. I mean, you might shop around and find out what's the best deal you get from the various institutions, but
Okay.
it's just having a separate one is the important thing.
In a sole proprietorship business, how do you know how much self-employment tax to pay? Based on the income or the net income?
It's 15.3% of the net income, bottom line.
Mm-hmm.
Great. So even
Gross income minus business expenses, not any kind of payments or distributions that they take out themselves.
Right.
Okay. And I think this is our last one. So even if an artist has several degrees in their art, they're not pulling a profit and need a day job, they are seen as a hobby artist in the eyes of the IRS? I guess define hobby artist.
Well, under that hobby law, it's like I say, the fact that if someone is getting a salary from a day job and then they're doing this other activity, I mentioned they have formulas. They're called defunctions, where they'll do a computer kick out if they see that law says a sole proprietor when you have wages from your day job. So, but that's a rebuttable presumption that if you can say, hey, I'm running it like a business. I make changes in the way I do things. I consult with other professionals. I mean, there are ways of overcoming that.
But the fact that somebody is very professional in what they do, and then they have degrees and they're very competent, they're well known in their field, the IRS, if they don't make money at it, the IRS may say, yes, that's a hobby. So to answer you, so I understand where the person's coming from. They don't view it as a hobby, but the IRS, yeah. And when the IRS treats it as a hobby, all they're saying is we're not going to let you deduct that loss against your other income. Right. They're not trying to disparage them. They're just trying to say that.
And the burden of proof is on the taxpayer.
Right. That's what the presumption does, is by not having income in 3 out of 5 years, it shifts the burden of proof to the taxpayer to say, no, I really am. Because the IRS all they have to say is, you don't have it, therefore you're not, it's a hobby. And then you would have to come back and prove that it is a real business.
Okay. I was surprised this year to find I was considered a sole proprietor. Do I want to be a sole proprietor or hobby artist? My taxes were high and I wasn't prepared with expenses that I could have written off.
I'm not sure what the question is, but
right.
but if you are in the business and you're trying to make money at it and you happen to lose money, then you're in the business and you can offset those losses against other income. Now, if the hobby loss rules come in, if you do that for a number of years in a row, then the IRS says, we don't think that's a business that you're entered into for profit, and therefore you can't deduct it against your other losses. But if you're in it and you're trying to make money at it and you just don't happen to make money at it, they'll let you deduct that against other income.
Okay. Well, that concludes our webinar. Thank you so much, Bill and Ralph. We cannot thank you enough for taking the time, especially during this busy tax season, to help us artists and arts organizations. And have a wonderful afternoon, everyone. And this will be available. We did record it, so it will be available on our website under the Create You webinar series, hopefully by tomorrow afternoon. So thank you all for joining us, and thank you again, Ralph and Bill.
Thank you.
Thank you.
All right, bye.
Bye.